the news of the day. Inflation numbers are out. Newsflash, ain't nothing changing. Inflation is not transitory in terms of price increases. The official inflation numbers that were reported today is the CPI, the consumer price index, is at 5.4%. The core inflation number, if you take out food and energy, is at 4.3%. The Federal Reserve's target historically has been 2%. Yet we are at inflated levels of inflation. But those are the official numbers. Nobody believes the official numbers. I don't believe them. Nobody here believes them. The Federal Reserve doesn't believe them. Wall Street doesn't believe them. And consumers don't believe them. It is the open secret of the financial system is that the official inflation numbers are not accurate. What is true inflation? I don't know. Neither does anybody else. It is a very complex thing to try to figure out. And people do their absolute best to try to actually get to the end result. But nobody knows what the inflation numbers are. All we do know is that the official numbers are undercounting what true inflation is. The other piece of this conversation that is very important is that everyone in a society does not experience inflation equally either. If you are in the top 20% of Americans from a net worth standpoint, you are much more likely to be a beneficiary of inflation rather than have it hurt you. If you are in the bottom 20% of Americans, you hold no investable assets, you work an hourly job, you live paycheck to paycheck, and you save 100% of your wealth in cash, you are absolutely getting destroyed by inflation. And so even with high levels of inflation, everyone does not experience it the same. And so we've got a ton of charts. We went deep. We did tons of research. The Best Business Show research team. John was all over the interwebs. He outsourced some of the chart creation to the team in New York. He's laughing. Eventually people will get that joke. But here's all the charts that we've got. Rising prices. We're going to start right from the top. U.S. CPI is expected to moderate some in July, but remain elevated. Newsflash. We still have that CPI number coming in at 5.4%. Exactly what it was in June. So this was inaccurate. Next up, we have seasonally adjusted changes from the preceding month. When you start to break this down, now this looks like somebody typed it up on a typewriter, just to be clear. This does not look like anyone used a computer to create this. But when you start to actually break down what's here, what you can see is that there are some things that are going down, but some things are increasing. So for example, we can look in July. Let's say the new vehicle inflation month over month grew 1.7%. From last month to July, right? From June to July, 1.7%. If you look at something like gasoline, 2.4%. Energy commodities in general, 2.3%. And then energy as an entire sector, 1.6%. And so you can go through this entire chart and you can literally see point after point after point, including things like food up 0.7% month over month. And so when you start to understand how high some of this inflation is, you realize that it is concentrated in certain areas. And so if you go and you actually look at individual categories like clothing, food, or personal care, you can see massive price jumps. And so this next table that we have here comes from the Bureau of Labor Statistics, and it shows month over month percentage increases in CPI. Women's dresses are up 5.5%. That's the largest gain since 2012. That has nothing to do with supply chains. Personal care services up 2.2%. The all-time high, highest growth month over month. Motor vehicle repairs, not buying the cars, new or used, the actual repair of the vehicle, up 2% month over month. The absolute highest gain on record. World record growth in motor vehicle repair month over month. The vehicle accessories outside of tires up 1.6%, pets and pet products up 1.4%, and the food away from home. They literally break it down. So it's not just food you eat at your home, it's also food away from home. Posted a 0.8% month over month gain. This is not over a year. This is literally from June to July. The food away from your home had the largest gain since 1981. Absolutely bonkers. And if we go and we look just all items in a US city on average, you can see the year-over-year comparison. This is crazy. In over 13 years, this is the highest that we've had on record. And so when you start to see these types of numbers, it begs the question, can we separate the conversation between inflation as a rate of change versus a price increase? And I'll get to that in a second. But the other piece here is the select components of CPI. Used cars and trucks are almost off the chart. I mean, literally, it is just zooming. We are just popping. We're going to Mars on the new cars and trucks on this chart. And then on the other chart that we have is the used cars. So new cars and trucks, literally, we're just off the chart going to Mars. And then when we break it down by actual components of CPI, used cars and trucks on the far right, again, 41% year over year change. Energy up 23%. Commodities outside of food and energy up 8%. And if you even look at food and shelter, those are both 2.8, 3.4%. They are above the Fed's 2% target. And so when you start to actually look at this, you can see that this is not just the supply chain disruptions around housing or around energy or around some sort of vehicle creation. This is across sectors. Apparel, clothing is up 4% over the last 12 months. Absolutely bonker numbers when you think about a society that is built on the premise that the increase of prices will only be about 2%. So when we start to think about this, it is important to remember that words matter. The nomenclature that is used is very, very important. You will hear people say inflation is transitory. And what they are explicitly stating is that the rate of change, that 5.4% in CPI over the last 12 months, is the rate at which inflation has changed in these goods. That won't continue to be over 5% in the future. Well, that essentially would mean that inflation was compounding. And so that we would have to continue to grow at more and more faster pace in the future. Of course, that's not going to happen. That's not how math happens. Cars are not going to be worth millions and millions of dollars. They only can go up so much. But what it doesn't explain is that the price increase is not going away. So while the rate of change measured as inflation today is not going to continue to stay at inflated levels, the price increases that society is experiencing and the bottom 45% of Americans are getting hurt by are here to stay. Chipotle and other fast food restaurants are not going to decrease their prices in the future. Those car prices that are going up are unlikely to come down anytime soon. On top of that, things like apparel or other types of goods will continue to be sold at elevated prices. Part of that is because you have increases in the labor market. If I go to an employee and I say, hey, I am now going to pay you $15 an hour. Next year, I'm not going to come back to you and say that I'll only pay you $13. I have to pay you $15 or more into the future. And therefore, if labor costs are going up, if the cost of my goods are going up, then I have to increase the prices of what I sell to my consumer so that I can pass those cost increases on to the customer. I am not going to make less money as a business simply because I have to pay my employees more. You as the end customer are going to pay more. It is crazy to think that people actually want to explain that prices are going to come back down. They're not going to. The rate of change is going to slow. We are not going to go from 5 to 10 to 15 to 20% over the next 3-4 years because that would insinuate a doubling, tripling, quadrupling of prices in these goods. But as we see a rapid appreciation of prices, you have to remember 78% of Americans live paycheck to paycheck. 78% of Americans live paycheck to paycheck. 45% have no investable assets. People are being hurt, and we're pretending like nobody should be worried. Used cars in America are up 41% over the last 12 months. You would have been better off buying a used car and flipping it in the last 12 months than buying the S&P 500. The S&P 500 is up 33% in the last 12 months. Used cars are up 41%. You would have returned 33% more than the S&P 500 if you would have bought a car in the used market and turned around and sold it now. That's nuts. But that is what is happening.
Hey guys, thanks so much for watching that clip of The Best Business Show. Make sure you like and subscribe to the channel, turn on notifications so you know when we go live every weekday, and then head to SoFi.com/pomp so that you can get an account and we can get after it.